Most people don't realize this, but when they invest in the stock market, they're usually making it far more complicated than it needs to be. Many people think investing means picking the right stock, watching the market every day, trying to beat everyone else, or knowing something the average person doesn't. Because of that, a lot of people either never start investing at all, or they start, feel overwhelmed, and eventually give up. But here's the truth. Some of the most successful investors in the world don't pick individual stocks. They use something called an ETF. And once you understand what an ETF actually is, investing starts to make a lot more sense. By the end of this video, you'll understand exactly what an ETF is, how it works, and why so many long-term investors rely on them instead of trying to pick winners. Welcome to Aaron's Money Manual, where we simplify money so you can stress less, live more, and actually make your hard-earned cash work for you. If you like beginner-friendly investing explained clearly and without hype, make sure to subscribe for weekly videos. ETF stands for Exchange Traded Fund. The name sounds complicated, but the idea behind it is very simple. An ETF is a collection of investments, usually stocks, bundled together into one fund that you can buy and sell just like a regular stock. Instead of buying shares of one company, an ETF lets you buy small pieces of many companies at the same time. Buying a single stock is like betting on one horse in a race, while buying an ETF is like owning a small piece of the entire race. You're not relying on one company to succeed. You're spreading your money across many companies at once. What's inside an ETF depends on what the ETF is designed to track. Some of them track the S&P 500, which represents 500 of the largest companies in the United States. Popular examples of these include ticker symbols like SPY, IVV, and VOO. Other ETFs track the entire US stock market, such as VTI, which includes thousands of companies of all sizes. There are also ETFs that focus on specific sectors, like technology, with examples such as QQQ or XLK, and ETFs that focus on international markets, like VXUS, which holds companies from outside the United States. When you buy one share of an ETF like these, you instantly get exposure to all of the companies inside it in a single purchase. There's no need to pick individual winners or constantly adjust your investments. ETFs were created to make investing simpler, cheaper, and more accessible to everyday people. Before they existed, proper diversification required buying dozens or even hundreds of individual stocks, which wasn't realistic for most investors. An ETF solved that problem by packaging diversification into one investment. That's why they're so widely used in retirement accounts and by long-term investors who want steady growth without constant decision-making. One thing that makes an ETF unique is that they trade on the stock exchange just like regular stocks. You can buy and sell them during market hours, their prices move throughout the day, and you can purchase them through the same brokerage you already use. Even though an ETF holds many investments under the hood, from the outside it behaves like a single stock. That combination of diversification and flexibility is what makes an ETF so powerful. ETFs don't eliminate risk, but they do spread it out. If you own a single stock and that company struggles, your investment can take a major hit. But if you own an ETF holding hundreds or even thousands of companies, one company performing poorly has very little impact on the overall investment. Your results are driven by the overall market or sector rather than the success or failure of one business. This is why ETFs are commonly used by investors who want long-term growth instead of short-term speculation. Over long periods of time, most individual investors underperform the market. This isn't because they're unintelligent, but because investing emotionally is extremely difficult. People panic sell during downturns, chase trends when prices are high, and make decisions based on fear or excitement. An ETF removes much of that emotional pressure. You're not reacting to one company's bad news or constantly questioning whether you picked the wrong stock. You're investing in the broader system, which makes it easier to stay consistent, and consistency is what drives real results over time. Another advantage of an ETF is cost. Most broad market ETFs have very low fees compared to actively managed funds. These fees are usually a tiny percentage each year, often less than 1/10 of 1%. While that may sound insignificant, over decades those lower costs can add up to tens or even hundreds of thousands of dollars more in your pocket. Just like returns, fees compound, so keeping them low matters. Many ETFs also pay dividends. If the companies inside the ETF pay dividends, those payments are passed on to you. Some investors choose to reinvest those dividends automatically to accelerate long-term growth, while others use them as income. ETFs give you that flexibility without requiring frequent decisions or constant monitoring. ETFs are especially beginner-friendly because they provide instant diversification, reduce the impact of individual mistakes, require less time and effort to manage, and remove the pressure to pick the perfect stock. You don't need to be an expert, you don't need to predict the future, and you don't need to watch the market every day. What matters most is staying consistent and giving your investments time to grow. The biggest mistake people make with ETFs isn't choosing the wrong one, it's expecting them to work quickly. ETFs are not designed for overnight success, they're designed for long-term growth. When people treat an ETF like a get-rich-quick tool, they get disappointed. When they treat them like a system and stick with them over time, they tend to work exactly as intended. ETFs are ideal for people who want to invest without constant stress, prefer simplicity over complexity, and are focused on long-term results rather than short-term excitement. They're not flashy and they're not exciting, but they're effective. And in investing, boring often wins. So to recap, an ETF is a collection of investments bundled into one fund. It allows you to invest in many companies at once, reduces risk through diversification, keeps costs low, and helps investors stay consistent over time. You don't need to outsmart the market to build wealth. You just need a strategy that works and the discipline to stick with it. Thank you for watching Aaron's Money Manual. I really appreciate you being here and taking time to learn how investing actually works. If you enjoyed this video, check out some of my other videos where I break down money and investing in a simple, practical way. I post new videos regularly, and I'd love to have you back for the next one. Thanks again for watching, and I hope to see you next time.